In 1989, Tokyo's Imperial Palace grounds were valued at more than all the real estate in the entire state of California. Japanese commercial real estate had reached such absurd heights that a single square meter of prime Tokyo office space cost more than an average American home. Banks were lending money against property values that doubled every year. Developers built skyscrapers before finding tenants. Investors bought buildings they never intended to occupy, planning only to sell them months later at enormous profit. Everyone knew it couldn't last forever, but everyone believed they would exit before the crash. They were wrong. When Japan's commercial real estate bubble finally burst in 1991, it triggered what economists now call the lost decades. Property values in Tokyo fell 87% from peak to trough. Banks that had lent trillions of yen against inflated property values suddenly held worthless collateral. Major financial institutions collapsed. The Nikkei stock index, heavily tied to real estate speculation, plummeted from 39,000 to 15,000 inches 2 years. But here's what makes Japan's crisis relevant to America today. It didn't happen overnight, and almost nobody saw it coming until it was too late. The warning signs were dismissed. Experts claimed Japanese real estate was different, that unique factors justified the valuations. Tokyo is an island with limited space, they said. Japanese companies need prestigious headquarters, they argued. Cultural factors make Japanese real estate special, they insisted. Every bubble tells itself the same lie. This time is different. Fast forward to 2007 inches, the United States. Commercial real estate values had climbed steadily for 15 years. Strip malls, office towers, shopping centers, and apartment complexes were trading at record prices. Banks were packaging commercial mortgages into securities and selling them to investors worldwide, just as they did with residential mortgages. The financial engineering was complex, but the underlying assumption was simple. Commercial real estate values always go up. Then everything collapsed. Lehman Brothers, one of America's largest investment banks, filed for bankruptcy in September 2008. The immediate trigger wasn't residential mortgages, as most people assume. Lehman's fatal wound came from its massive exposure to commercial real estate. The bank had borrowed billions to invest in office buildings, shopping centers, and development projects. When property values started falling and credit markets froze, Lehman couldn't refinance its short-term loans. Within weeks, the 158-year-old institution was gone, taking down with it trillions in asset values and nearly destroying the global financial system. The 2008 crisis taught the world that commercial real estate isn't just about buildings. It's about the banks that lend against those buildings, the pension funds that invest in those banks, the insurance companies that guarantee those investments, and the entire interconnected web of financial institutions that assume property values will remain stable. When that assumption breaks, the cascading failures can destroy economies. Governments and central banks responded to 2008 with unprecedented intervention. The Federal Reserve dropped interest rates to near zero and held them there for 7 years. They printed over $4 trillion through quantitative easing. Congress passed massive stimulus programs. These emergency measures stabilized the system and prevented complete collapse, but they also created the conditions for an even larger bubble. Here's what happened next. With interest rates at historic lows, investors desperately searched for returns. Bonds paid almost nothing. Stocks seemed overvalued. So money flooded into real estate, especially commercial real estate, which offered higher yields than other safe investments. Private equity firms raised hundreds of billions to buy office buildings, retail centers, and apartment complexes. Real estate investment trusts expanded dramatically. Foreign investors parked money in American commercial property. Prices climbed year after year, surpassing even the 2007 peak. By 2019, total U.S. commercial real estate was valued at approximately $20 trillion, double its 2009 value. Office buildings in Manhattan traded at prices that assumed 95% occupancy rates and steadily rising rents forever. Regional malls purchased at premium prices assumed Amazon and online shopping would never seriously threaten retail. Luxury apartment buildings financed with cheap debt assumed young professionals would continue paying ever-increasing rents indefinitely. The entire $20 trillion edifice rested on 3 assumptions. Interest rates would stay low, property demand would keep growing, and refinancing would always be available. Then 2020 arrived and broke all 3 assumptions simultaneously. The COVID-19 pandemic forced millions of office workers home in March 2020. Companies discovered something unexpected. Remote work actually worked. Productivity didn't collapse. Expensive downtown offices suddenly seemed unnecessary. Tech companies that had signed leases for millions of square feet of new space began reconsidering their needs. Within months, office occupancy rates plummeted from 95% to below 50% in major cities. But surely this was temporary, analysts said. Workers would return to offices once vaccines arrived and the pandemic ended. Companies invested in return-to-office plans. Building owners offered incentives and upgraded facilities, except the workers never fully came back. As of 2024, office occupancy rates in major American cities average just 50 to 60% of pre-pandemic levels. Many companies adopted permanent hybrid or remote policies. Tech firms that had leased entire skyscrapers are now trying to sublease half their space. Even companies demanding office returns find that only 60 to 70% of employees show up on any given day. The implications are staggering. A half-empty office building can't support the debt taken out when it was 95% full. Landlords can't cut their mortgage payments in half just because occupancy dropped. The numbers stop working. In New York City, office vacancy rates hit 20% in 2024, the highest since records began. In San Francisco, vacancy exceeds 30% in some neighborhoods. These aren't temporary setbacks. This is structural change in how and where people work. Meanwhile, retail commercial real estate faces its own apocalypse. The shift to online shopping, accelerated by pandemic lockdowns, has proven permanent. Department stores that anchored malls for decades are closing. Retailers that survived are negotiating lower rents or walking away from leases. Mall traffic in 2024 remains 30% below 2019 levels. Of the roughly 1,200 enclosed malls in America, analysts estimate 300 to 400 will close or be repurposed by 2030. The dead mall phenomenon that started in declining Rust Belt cities is now spreading to suburbs nationwide. Building owners purchase these properties with debt, assuming stable cash flows. Those cash flows are evaporating. And here's where it gets truly dangerous. Most commercial real estate debt doesn't work like home mortgages. Commercial properties are typically financed with loans that last only 5 to 10 years. At the end of that period, the owner must refinance, taking out a new loan to pay off the old one. This system works fine when property values are stable or rising and interest rates are low. But when property values fall and interest rates spike, refinancing becomes impossible. Between 2020 and 2023, the Federal Reserve raised interest rates from near zero to over 5%, the fastest increase in 40 years. This decision, necessary to combat inflation, created an impossible situation for commercial real estate owners. Consider a simple example that illustrates the crisis. In 2019, an investor buys an office building for $100 million, putting down $20 million and borrowing $80 million at 3% interest. The annual debt payment is roughly $2.4 million. The building generates $5 million in annual rental income, leaving $2.6 million in profit after debt service. Everyone's happy. Now it's 2024 and the 5-year loan must be refinanced. But 3 things have changed. First, the building is now only 60% occupied instead of 95%, so rental income dropped to $3 million annually. Second, new loans cost 7% instead of 3%, so the annual debt payment on $80 million would be $5.6 million. Third, with lower income and higher rates, banks value the building at only $60 million instead of $100 million. The bank offers to refinance, but only 70% of the new appraised value, meaning a loan of just $42 million. The owner needs $80 million to pay off the old loan, but can only borrow $42 million. To refinance, the owner must come up with $38 million in cash immediately. Most owners don't have that cash. They default. The bank forecloses, sells the property at a loss, and that loss hits the bank's balance sheet. Now multiply this scenario by thousands of properties and hundreds of billions in loans coming due. Over $1.5 trillion in commercial real estate loans mature between 2024 and 2026. Many of these properties are underwater, worth less than the debt against them. The owners can't refinance and can't sell without massive losses. They face a choice between injecting enormous amounts of new cash or walking away from their equity entirely. Many are choosing to walk away. In 2023 and 2024, defaults on commercial real estate loans surged to levels not seen since 2010. Office building defaults hit 8%, compared to just 1% in 2019. Retail property defaults exceeded 6%. Even multifamily apartment buildings, previously considered safe, started showing stress as overbuilding and slowing rent growth squeezed returns. The first casualties were the small and medium regional banks that specialized in commercial real estate lending. In March 2023, Silicon Valley Bank collapsed in the second largest bank failure in American history. While the immediate trigger was a run on deposits, the underlying problem was unrealized losses on the bank's holdings, including commercial real estate loans. First Republic Bank failed 2 months later. Signature Bank closed the same weekend as Silicon Valley Bank. All 3 had significant commercial real estate exposure. These failures triggered contagion fears throughout the banking system. Depositors pulled money from regional banks, forcing fire sales of assets and exposing more losses. The Federal Reserve and Treasury Department intervened with emergency programs to guarantee deposits and provide liquidity. They stopped the immediate panic, but they couldn't solve the underlying problem. Commercial real estate values had fallen while debt levels remained unchanged. Here's what makes this crisis potentially worse than 2008. The losses are spread differently. In 2008, much of the risky lending had been packaged into securities and sold to investors worldwide. When mortgages defaulted, losses hit bondholders, pension funds, and foreign banks. This was devastating, but also meant losses were somewhat distributed. In 2024, more commercial real estate debt sits directly on bank balance sheets, especially at small and medium regional banks. These are the banks that fund local businesses, provide construction loans, and support community development. When they fail, credit dries up in entire regions. Small businesses can't get loans. Real estate transactions freeze. Economic activity contracts. The geographic concentration makes it worse. Cities like San Francisco, Seattle, and Austin that boomed during the tech expansion now face severe commercial real estate distress. San Francisco office buildings have sold at 70% discounts to their 2019 values. Entire skyscrapers stand empty. Property tax revenues, which cities depend on to fund schools, police, and infrastructure, are collapsing. San Francisco faces a $1.5 billion budget deficit, partly due to falling property tax collections. When cities cut services, quality of life declines, businesses leave, and property values fall further in a doom loop. The contagion spreads through multiple channels. First, direct lending losses hit bank capital. Second, falling property values reduce property tax revenue, stressing municipal budgets. Third, empty buildings mean lost business for nearby restaurants, shops, and services. Fourth, construction workers and property managers lose jobs. Fifth, pension funds and insurance companies holding commercial real estate investments see their assets decline. Each channel reinforces the others. Some experts argue this crisis is manageable because banks are better capitalized than in 2008 and regulators learned from past mistakes. They point out that residential real estate remains relatively stable, consumer balance sheets are healthy, and the overall economy continues growing. They suggest banks will extend and pretend, working with borrowers to avoid foreclosures while waiting for property values to recover. This optimistic view assumes time will heal the problem. But what if structural changes mean commercial real estate values won't recover to previous levels? What if remote work is permanent and cities truly need 30% less office space? What if online shopping continues taking market share from physical retail? What if the supply of new apartment buildings exceeds demand as population growth slows? These aren't temporary disruptions, but permanent shifts in how Americans live and work. The mathematical reality is inescapable. If a property generates $3 million in annual income but requires $5 million in annual debt payments, no amount of time will make the math work. The debt must be reduced, which means losses for lenders. Multiply this across thousands of properties and you get hundreds of billions in losses that must be recognized. The question isn't whether these losses exist, but who ultimately bears them. Some losses will hit bank shareholders as stock values fall. Some will hit bank bondholders if banks fail. Some will be covered by FDIC insurance, meaning taxpayers. Some will impact pension funds and insurance companies holding commercial real estate securities. Some will devastate individual investors who bought property with the wrong assumptions. The political response will be critical. In 2008, bank bailouts proved deeply unpopular and fueled movements like Occupy Wall Street and the Tea Party. Voters across the political spectrum resented using public money to rescue institutions that took reckless risks. Any similar bailout in 2024 or beyond will face fierce opposition. Yet, allowing thousands of banks to fail and commercial real estate markets to completely collapse would trigger depression-level economic contraction. Policymakers face an impossible choice between unpopular bailouts and economic catastrophe. Some propose converting empty office buildings into housing, solving two problems simultaneously. This sounds elegant, but proves difficult in practice. Office buildings are designed differently than residential spaces, with large floor plates, limited windows, and plumbing concentrated in cores. Conversions cost $200 to $400 per square foot, often exceeding the value of the resulting apartments. It only makes economic sense for a small subset of buildings in the most desirable locations. Most empty offices will remain empty or be demolished. History shows that commercial real estate busts take years to resolve and leave lasting scars. Japan's bust lasted over a decade and contributed to 20 years of economic stagnation. The 2008 crisis took 5 years before commercial real estate values bottomed and another 5 to recover. The current crisis combines high debt levels, structural demand shifts, and rising interest rates in a mixture more toxic than previous cycles. The $20 trillion commercial real estate market isn't going to zero. Buildings will still have value and tenants will still need space. But a decline from $20 trillion to $15 trillion means $5 trillion in losses that must be absorbed by someone. That's more than twice the losses from the 2008 crisis. Those losses will ripple through the financial system in waves over the next several years, with each wave threatening stability and requiring policy responses that will reshape American capitalism for decades.